Hey everyone! In this video, we are going to cover the entire standard 116 leases in a very short and crisp manner. But we are not going to leave any topic which ICAI has incorporated in its material. And I assure you that it will be very helpful in your final revision before exam. We will be covering the topic in same fashion as Institute has given in its material, starting from the recognition exemptions, ending with the practical experience, where the lessee may elect not to assess the rent concession as lease modification. So let us try to make the voluminous standard of Module 2 a simple one. Think from lessee's point of view from now onwards, and after that we will understand the treatment in Lessor's book. This standard gives a practical experience for electing not to apply Ind AS 116 recognition requirements, which means अगर हम चाहें तो 116 के प्रिंसिपल नहीं लगाएंगे if it is a short term lease or a lease of low value. But then how the lessee will recognize the lease payments in his books? The lessee will simply recognize the lease payments on a straight line basis or any other systematic basis. That is simply lessee अपने books में rent expense दिखा देगी. Short term leases means those leases where the lease term is of 12 months or less and does not include an option to purchase the underlying asset. And this assessment has to be made on the commencement date. We will later on understand what is commencement date and inception date. To qualify as lease of low value, two conditions must be satisfied. The first one, that the lessee can benefit from the use of underlying asset on its own or with readily available resources. And the second condition is that the underlying asset is not highly dependent. Also, if the nature of underlying asset is not of low value, like car, etc., then such leases cannot qualify for leases of low value. Also, if the lessee subleases or expects to sublease the asset, then the head lease does not qualify for lease of low value. मतलब इस केस में lessee या फिर intermediate lessor recognition exemption यूज नहीं कर सकता है एंड वो लोग को Ind AS 116 का requirements follow करना पड़ेगा. Next, we will understand the definition of lease as given in the standard. As per the standard, lease is a contract which gives the right to control the use of an identified asset for a period of time in exchange for a consideration. Every word in this definition has its own significance and needs to be understood. The assessment of whether the contract contains a lease or not has to be done on the inception date. So, it is now important to understand this term inception date. Inception date is defined as the earlier of date of lease agreement or the date of commitment by the parties to principal terms and conditions of lease. On this date, two important tasks need to be done. The first one, to check whether the contract contains lease or not. And the second one is classification of lease into finance lease or an operating lease. And this classification is to be done from the lessor's point of view. Because we know that in lessee's books, there is no such classification. We are required to do same type of accounting for both the leases. Commencement date is the date on which the lessor makes the underlying asset available for use by the lessee, and from this date only the accounting of lease commences. Also, the lease term is defined at this date. And if it happens that the lease term is of 12 months or less, then the lessee may opt to apply the practical expedient. For assessing whether a contract contains lease or not on the inception date, we need to check the right to control, identifiability of asset, period of time, and the consideration. Let's understand in a detailed manner all these terms. For an asset to be identifiable, it must be specified in the contract, whether explicitly or implicitly. Also, we will have to check that supplier do not have substantive substitution right, and then we will conclude that the underlying asset is an identified asset. Supplier is said to have substantive substitution right if he has the practical ability to substitute the alternative asset, and he would benefit economically from such substitution. This substitution right should be substantive only when it is for the entire period of lease. If this right is available only after a particular date, then we can't say that these rights are substantive. The NDS has also clarified that customers should presume that supplier substitution right is not substantive. When the customer cannot readily determine that supplier has a substantive substitution right. Also, if there are certain contract terms which allows or requires the supplier to substitute the alternative asset only when the underlying asset is not properly operating, like normal warranty provision, then in that case it would not create a substantive substitution right. To assess whether the contract conveys the right to control the use of identified asset for a period of time, then the entity will assess whether the customer has both of the following rights. The first one, right to obtain substantially all economic benefit from the use of identified asset, and the second one, right to direct the use. And these rights should be present throughout the period of use. And so, if the customer has the right to control the asset only for a period of time and not for the entire contract term, then we can conclude that the lease is present only for that portion of time. Till now, we have learned to check whether a contract contains lease or not. In this portion, there is also an important concept given of protective rights. Protective rights are defined as where the supplier can prevent the customer from having the right to direct the use of an asset. Let's take an example. Let's say supplier A has leased out his vehicle for a period of 5 years to customer B. But supplier A has prohibited certain uses of vehicle and modification to the vehicle to protect the interest of the asset. So such rights will be considered as protective rights, and it will not affect the assessment of whether the customer B can direct the use of the asset. So such a contract can also be considered as a lease even if the supplier has protective rights with himself. Next we come to the concept of separation of lease and non-lease components. There are certain contracts which contains the right to use multiple assets. For example, a building and equipment are leased out. In this case, the contract contains right to use multiple assets, and there may be separate lease component if two conditions are satisfied. The first one, lessee can benefit from the use of asset either on its own or together with other resources which are readily available to the lessee. And the second one, the underlying asset is highly dependent. If both of these conditions are satisfied, we can say that there are separate lease components. And if any one of the condition is missing, then we can't account for them as separate lease components. In addition to this, there may be many contracts which contains lease components and non-lease components. In such a case, the non-lease components are to be identified and accounted separately from the lease component, because the lease component will be accounted as per Ind AS 116, and the other part, that is non-lease component, will be accounted as a executory arrangement by the lessee or as per Ind AS 115. But then this Ind AS has also provided a practical expedient which permits the lessee to make a accounting policy election where it can account for each of the separate lease components and non-lease component as a single lease component. And this relief is given only to the lessees and not to the lessor. So where the lessee makes the use of this practical expedient, the entire consideration will be considered as the single lease component and will be accounted accordingly. But if it is a case that lessee do not want to make the use of practical expedient, then he will have to allocate the consideration to each of these components on the basis of relative standalone price basis. There is an illustration given in ICI material where you can understand the concept more clearly. Next we come to the concept of lease term. The lease term begins at the commencement date, that is when the lessor makes the underlying asset available for use by the lessee. Lease term is equal to the non-cancellable period plus the extendable period if the lessee is reasonably certain to exercise the option, and the termination period if the lessee is reasonably certain not to exercise the option. Let's take an example to understand this lease term concept more clearly. Let's say the term of contract is 10 years and the non-cancellable period or the lock-in period is of 6 years. There may be three cases in this. First one, the termination option is available with the lessor. In this case, the lease term will be of 10 years because even after 6th year, the lessee would be contractually bound and he cannot refuse to make payments to the lessor. In the second case, the termination option is available with the lessee. In this case, the lease term will be 10 years if we assume that there is reasonable certainty that after 6th year, lessee will not refuse to make the payment and will not exercise the termination option. But if we assume the other way, then the lease term will be 6 years. And the third case, where the termination option is available to both the lessor and the lessee. In this case, the lease term will be considered as 6 years only if there is insignificant penalty on termination. This is because after 6th year, either of the party can terminate the lease without the consent of the other party. I think till now we have completed all the theoretical portion, and now we will move on to the practical part from where generally question comes in exam. For solving practical question, we need to calculate the lease payment which are paid by the lessee to the lessor relating to the right to use asset. It comprises of mainly 5 things: the fixed lease payment minus the lease incentive which the lessor pays to the lessee, the variable lease payments which are dependent upon index or rate, the exercise price of purchase option if it is reasonably certain that lessee will exercise the purchase option, penalty for terminating, and the expected residual value guarantee. It will be more clear if you solve question related to this. Also, we require to calculate the initial direct cost, which are referred to as the incremental cost for obtaining a lease that would not have been incurred if the lease has not been obtained. For example, the legal fees which are paid for services rendered before the execution of lease. While calculating the cost of ROU asset, we will have to add this initial direct cost to the lease liability. We also require a discount rate for discounting the lease payment. Since we know that lease payments are paid over the period of contract term and not at a single time, so we require a discount rate to find the present value of these lease payment, and that present value will be considered as the lease liability. We can use the interest rate implicit in the lease if it is available, or we can use the lessee's incremental borrowing rate. The interest rate implicit in the lease is nothing but lessor's IRR, and it is the rate which causes the PV of inflow to the lessor to be equal to the outflow to the lessor, and it needs to be calculated. Otherwise, we can use lessee's incremental borrowing rate. Now we will learn how to measure the right to use asset. The cost of ROU asset includes the initial measurement of lease liability plus all the indirect cost incurred by the lessee. In addition to this, all the payments which are made by the lessee to the lessor before the commencement date will also be included, and the lease incentives received by the lessor will be deducted from it. And lastly, we will add to it the estimate of cost of restoration, like we do in PPE, if we have the information available with us. For subsequent recognition, we will do the same accounting which we follow in Ind AS 109 for financial liability at amortized cost. And for subsequent recognition of ROU asset, we will simply deduct the accumulated depreciation and all the accumulated impairment loss, if any. The ROU asset can be measured as per cost model or as per revaluation model. If the ROU asset relates to a class of PPE for which the lessee applies revaluation model in Ind AS 16, then the lessee may elect to apply revaluation model to all of such ROU asset. However, if the ROU asset meets the definition of investment property as per Ind AS 40, then in that case, revaluation model will not be applied and only cost model is allowed. The lessee in his P&L will record following expenses: the depreciation for the ROU asset, interest expense on the lease liability, and impairment, if any, on ROU asset. For the calculation of depreciation on ROU asset, it will be done on straight line basis over the lease term generally. But if it is a case where the ownership of the asset is likely to transfer at the end of lease term, then in that case the depreciation will be calculated over the entire economic life of the underlying asset. There is a small section given in the book about leases denominated in foreign currency. It was also given in November 2020 RTP, so I feel that question may be tested in exam related to this concept. Ind AS 21 will apply to the leases denominated in foreign currency. Since lease liability is a monetary liability, we will have to measure the lease liability on reporting date at that exchange rate, that is closing rate. And any changes in lease liability due to the exchange rate changes, that will be recognized in profit and loss as exchange gain or exchange loss. But ROU asset is a non-monetary asset, and so it will be measured at historical cost. So there will be no changes because of exchange rate. Next is the concept of remeasurement to lease liability, where there is a change in lease payment on account of any of the changes like expected residual value guarantee, remeasurement of lease term, reassessment of purchase option, etc., then in that case we will have to remeasure the lease liability. And we need to keep in mind when we will have to apply the original discount rate and when we will have to apply the revised discount rate. There are two cases where we will use the revised discount rate and three cases where we will use the original discount rate. These will have to be kept in mind while solving questions. Now we come to the most important part of this chapter, that is modification to lease. There are two cases where modification are accounted as a separate lease and where modification is not accounted as a separate lease, but we need to do some different kind of accounting. If additional ROU asset is granted and the price of additional ROU is commensurate with the standalone price, then in that case modification will be considered as a separate lease. So accordingly, at the commencement date of new lease, the lessee will recognize the ROU asset and lease liability relating to the new additional ROU asset granted, and the other one where modification is not accounted as a separate lease. If any of the two conditions given in the previous slide is not present, then modification will not be accounted as a separate lease. So what we will have to do in that case? If it is a case of change in consideration or increase in lease term or increase in the scope of ROU asset, then in that case we will remeasure the lease liability at modification date. First we will find the modification date and remeasure the lease liability by discounting the cash flows at present value and make the same corresponding adjustment to the ROU asset. That is, we need to pass a single journal entry and our work is done. For this we will use all the revised values. But if it is a case of decrease in lease term or decrease in scope, then we need to recognize the PL effect also. First we will de-recognize the lease liability and ROU asset proportionately to reflect the partial or full termination of the lease, and then recognize the PL in the PL the gain or loss on termination of the lease. For a better understanding of this concept, sums needs to be solved. Also, there is an important illustration given in ICI material where there is a modification in which there is both increase and decrease in the scope of lease. I guess illustration 37, solving that question, will help to give a more clarity on this concept. So till now we have learned about the accounting in the books of lessee. Now we will read about the lessor accounting. In the books of lessor, first we need to classify whether it is a finance lease or an operating lease. Till now we have not learned about this because after the advent of Ind AS 116, the concept of finance lease and operating lease has been removed from the books of lessee, but it is present in the books of lessor. Ind AS 116 has listed down certain examples where the lease can be classified as a finance lease. There are 5 of them. If the lease transfers the ownership of asset to the lessee at the end of lease term, then it can be classified as a finance lease. If the lessee has been given an option to purchase the asset at a price which is expected to be sufficiently lower than the fair value of the asset, in that case also it can be classified as a finance lease. The lease term covers the major portion of economic life of the asset. Even if the title is not transferred, we will consider it as a finance lease. asset is of such nature that only lessee can use it without major modification, then also it can be considered as a finance lease. And lastly, at the inception date, the present value of lease payment amounts at least substantially all the fair value of the asset, then in that case, it will be considered as a finance lease. The word substantially has not been defined here, but it can be considered as 90% generally. So if in question there is an indication of such thing, then in that case we will classify it as a finance lease in the books of lessor. If it is a case of finance lease, then in that case the lessor will have to de-recognize the carrying amount of underlying asset and recognize the net investment in lease, and the difference between the two will be reflected in profit and loss. This will have to be done at the commencement date, that is the date when lessor makes available the asset to the lessee. Derecognition of carrying amount of underlying asset can be done easily, but for recognizing the net investment in lease, we need to calculate this amount. For this, we'll have to calculate the present value of lease payment along with the present value of unguaranteed residual value. If it is a case of operating lease, then lessor will not have to recognize or derecognize anything. Simply, he will recognize all the lease payment from operating lease as an income, either on straight line basis or any other systematic basis. Now we come to the small concept of subleases, where the original lessee, now whom we can call intermediate lessor, subleases the underlying asset to the sublessee. Since now the original lessee becomes the intermediate lessor, so he need to classify the lease into finance lease or operating lease. If it happens that the lease is classified as a finance lease, then in that case he will have to de-recognize the ROU asset which is carried in his books and recognize the net investment in sublease. If it becomes the case of operating lease, then he will have to do nothing. The original lease liability and ROU asset will continue in his books, and he will only record the lease income. Now we move on to the concept of sale and leaseback transaction. To understand such transaction, let's take an example. Let's say entity A has sold its machinery to entity B, and immediately after such transaction, A has taken that same machinery on rent from entity B. So in this case, A becomes the seller lessee and B becomes the buyer lessor. Both of them are required to apply Ind AS 115 to determine whether to account for such transaction as a sale and purchase of an asset. If it happens that the control is passed from the seller to the buyer, then in that case we will account for such transaction as a sale and leaseback as per Ind AS 115. But if it happens that the control of underlying asset is not passed to the buyer lessor, then such transaction will be referred to as a financing transaction. When the sale and leaseback happens at off-market terms, that is, the selling price is not at par with the fair value of the asset, then there may be a hidden loan or a hidden prepaid rent. For such cases, there are certain adjustments required to be done, which you will understand by solving a question given in institute material. The same question was asked in November 2020 exams. Finally, we come to the last topic, which came as an amendment due to COVID-19 pandemic. This amendment is available only to the lessee, and lessor cannot make the benefit of this amendment. As a practical expedient, a lessee may elect not to assess the rent concession as a lease modification if all the conditions are satisfied given in para 46B. Previously हमने पढ़ा था कि अगर कोई changes होता है lease payment में, whether in form of rent concession, then in that case we have to do modification accounting. बट इस अमेंडमेंट के आने के बाद से अगर 4 कंडीशंस फुलफिल होती है जो कि पैरा 46B में दी गई है, देन लेसी के पास एक शॉर्टकट ऑप्शन है कि वो मॉडिफिकेशन अकाउंटिंग ना करके सिंपली वो शॉर्टकट ऑप्शन अपना ले. द कंडीशंस आर दैट द रेंट कंसेशन हैज ऑकर्ड एज अ डायरेक्ट कंसिक्वेंस ऑफ पेंडेमिक. द टोटल ऑफ न्यू लीज पेमेंट should be equal to or less than the original lease payment before such change. Reduction in lease payments affects payment due on or before 30th June 2021. And lastly, there should be no other substantive change to other terms and conditions of lease agreement. There is an option given to the lessee. It may do modification accounting or it may apply the practical expedient if all the above conditions are satisfied. If the rent reduction happens without any recovery, then in that case, a simple journal entry will be passed and lease liability will be reduced and the corresponding effect will be given in P&L. But if the rent reduction happens and afterwards the recovery is done, then for such cases no treatment will be done. And in all the cases, ROU asset will be tested for impairment. Also, if an entity has applied the practical expedient, then it will have to disclose this thing. I have tried to cover all the parts of chapter in a shortest possible time. Hope this video will be helpful in your final revisions. If it really helps in your final revision, then please like to the channel, subscribe to the channel. It really motivates me a lot. Thank you.